I have to be honest with you. When I logged into the terminal this morning, I actually refreshed the page 3 times. I thought the data feed was broken. I thought maybe I was looking at a glitch or, a typo.
It is the kind of number that makes you question your eyesight for sure.
$5,500, gold trading above $5,500 an ounce. I mean, we're talking about a 25% jump year to date, and we haven't even finished January.
And 27% in the last month alone. It's wild.
If this were some obscure crypto coin with a dog on it, fine, I'd understand the volatility. But this is gold. It's supposed to be the boring, steady grandfather of assets. What on earth is fueling a move this violent?
It is historic price action,
Okay.
absolutely. But here's the thing. If you're staring at the gold chart, you're actually looking at the smoke, not the fire.
Okay.
The fire isn't in the commodities market. It's burning in the bond market. Specifically, it's burning in the world's third largest economy, Japan.
Japan? That seems, well, unexpected. Usually when we talk about financial panic, we're looking at emerging markets or maybe a tech bubble popping in the US. Why is Tokyo suddenly the epicenter of a gold rally?
Because the Japanese government bond market, the JGB, has effectively acted as an anchor for global interest rates for decades, and that anchor has just come loose.
Right.
What we're seeing in gold is just a symptom. The disease is a fiscal crisis unfolding in Tokyo that is forcing a complete repricing of risk across the entire global financial system.
Okay, so our mission today is to connect these dots. We need to get from a bond trading desk in Tokyo to this historic $5,500 gold price and explain why this matters even if you don't own a single ounce of gold or a single Japanese yen.
That's the plan. And to understand the panic, you really have to understand the anomaly first.
Right, looking at the notes here, you flagged the yield on the 10-year Japanese government bond. It's climbed above 2.25%. Now, I have to play devil's advocate immediately. To a listener in the US or Europe, where we've been dealing with 4 or 5% rates, 2.25% sounds like free money. Why is that number a crisis level for Japan?
Well, context is everything here.
Yeah.
You have to remember that for over 3 decades, an entire generation of traders and bankers, Japan has existed in a kind of suspended animation of ultra-low and often negative interest rates.
So their whole system is built for zero.
Exactly. Their entire financial architecture is built on the premise that money costs nothing. The banks, the pension funds, the corporate balance sheets, they're all structured assuming rates stay near zero.
It's like a driver who has only ever driven at 20 miles per hour suddenly being forced to go 100.
It's a perfect analogy. The engine just isn't built for it. You build a skyscraper using materials that are perfectly stable at freezing temperatures. Suddenly the temperature jumps to 100 degrees, the materials extend, the integrity fails. That is Japan at 2.25%.
And it's up over a full percentage point from just a year ago.
In the bond world, that isn't a fluctuation. That is a structural failure.
But rates don't just spike in a vacuum. There's usually a trigger. Did the market just wake up and decide Japan was risky, or did something happen politically?
It connects right back to fiscal policy. We have to look at Prime Minister Shigeru Ishiba. He's been pushing a new fiscal stimulus package combined with proposed tax cuts.
Stimulus and tax cuts. In a vacuum, that sounds like the standard economic playbook, right? Stimulate growth, put money in pockets. Stock markets usually love that stuff.
Oh, equity markets might love it temporarily, but bond markets hate it. Bond markets look at the bill. You have to realize Japan's debt is projected to be around 230% of their GDP in late 2025.
230%.
It's the highest among all developed nations. It makes the U.S. debt load look almost manageable by comparison.
That's staggering.
It's a mountain of debt. So when the Prime Minister says we're going to spend more and tax less, the bond market does the math. They ask, how are you going to pay for this?
Yeah.
The only answer is issuing more debt or, printing more money.
So investors just get spooked.
They look at that 230% number and say, I don't think you can pay this back without debasing the currency. So they sell the bonds.
And just to clarify the mechanics for everyone, when investors sell bonds, the price of the bond drops and the yield, the interest rate the government has to pay goes up.
Precisely. And that selling pressure is what drove us to this 2.25% level.
Okay, so yields are rising. But here's what I struggle with. Japan has a central bank, the Bank of Japan, the BOJ. They have been the masters of market manipulation for decades. They literally invented yield curve control.
They did.
Why don't they just step in, print a few trillion yen, buy the bonds, and squash the yield back down? Why allow this to happen?
That is the trillion-dollar question. And the answer is why we are seeing gold at 5,500. The BOJ has lost the luxury of choice. They're currently caught in what I call an impossible bind.
An impossible bind.
They're trapped between two disasters.
Okay, let's unpack the trap. What's behind door number one?
Door number one is what you just suggested, yield suppression. They put in money, they buy the bonds, and they artificially keep interest rates low to help the government finance all that debt and to protect the banks.
Okay, that keeps the borrowing costs down. What's the problem with that?
The problem is the currency. It's just supply and demand. If Japan prints massive amounts of yen to buy bonds while the rest of the world is holding rates steady, well, the supply of yen floods the market. The currency gets crushed.
And the yen is already weak, right? Trading near 155 to the dollar.
Exactly. And you have to remember, Japan is an island nation. Very few natural resources. They import almost all their energy and a huge portion of their food.
So if the yen collapses?
You get imported inflation. The cost of living for the average Japanese citizen skyrockets. Heating your home, buying rice, it all becomes unaffordable. Inflation is currently holding at 2.1%, and they are desperate to keep it from spiraling.
So door number one saves the bond market but destroys the currency and spikes inflation. Got it. What's door number two?
Door number two is aggressive yen support. They stop printing. They maybe even raise rates aggressively to make the yen attractive again and stop the currency from bleeding out.
That sounds like the responsible hard money approach. Defend the value of your money.
It sounds responsible until you look at the balance sheets of the domestic institutions. Japanese banks, insurers, pension funds. They are all sitting on mountains of those old low-rate bonds we talked about.
Let me make sure I have the mechanics right here for the listener. Bond prices and yields move inversely. So if I hold a bond that pays, say, 0.1%, and suddenly new bonds are paying 2.25,
Nobody wants your old bond.
it's value tanks.
It's like holding a contract to sell apples for $1 when everyone else is selling them for 10. Your contract is worthless. Now imagine you are a major Japanese bank and you're holding billions of dollars of those old bonds. If yields rise, the price of those bonds crashes. That creates massive, unrealized losses on your balance sheet.
That sounds suspiciously like what happened to Silicon Valley Bank in the U.S. a few years ago.
It is exactly the same mechanic, but on a national scale. If the BOJ raises rates to save the yen, they risk technically bankrupting their own banking system.
Wow. So it's a pick your poison scenario, hyperinflation or a banking collapse?
Save the currency and break the banks, or save the banks and trash the currency. That is the trap.
So where do they stand right now? What are they actually doing?
Right now, they're trying to walk a tightrope. The BOJ has kept the short-term policy rate at 0.75%. They haven't confirmed any official intervention in the currency markets in 2026 yet, but they're doing a lot of verbal guidance.
Just talking the market down.
Essentially, they are threatening intervention. And interestingly, the yen recently strengthened about 1.71% just on the speculation that they might intervene. The market is on a knife's edge, just waiting for them to blink.
It feels like a high-stakes poker game where everyone knows the dealer is out of cards. But let's zoom out. Because I can hear a listener in Chicago or London saying, okay, this is dramatic for Tokyo, but if I don't live there and I don't hold JGBs, why do I care? Why is this my problem?
And that raises the most important point about global connectedness. You should care, because Japan isn't just an island economy. They are a massive creditor to the United States.
Specifically, they're the largest foreign holder of U.S. treasuries.
That's the one.
How much are we talking about?
They hold over $1.1 trillion in U.S. treasuries.
$1 trillion. Okay, I see the link forming now.
Go back to door number two. If Japan decides they must defend the yen, if they have to stop the currency from crashing, they need dollars. To buy their own currency back, they need to sell dollars. Where do they have $1 trillion parked?
In U.S. treasuries.
Exactly. So to save the yen, they might be forced to sell U.S. bonds. When the largest foreign holder starts dumping that much supply onto the market, what happens to U.S. bonds?
Supply goes up, prices go down, and U.S. yields go up.
Right.
So a policy failure in Tokyo could directly spike my mortgage rate, my credit card rate.
And we are already seeing it. The 30-year U.S. bond yields are at multi-year highs. That isn't just because of the U.S. economy. It's partly because the market is pricing in the risk of Japan selling. The market is front-running the BOJ.
The global spillover. But there's another layer to this, right? The carry trade. I keep hearing that term thrown around, usually without a clear explanation. Break it down for me.
It's simple, really, and it was the world's favorite trade for a long, long time. Here's the plain English version. Imagine you can borrow money from a bank in Japan for effectively 0% interest.
I'll take as much as you can give me.
Exactly. So you borrow 1 billion yen. You convert it to dollars. Then you take those dollars and buy a U.S. stock or a U.S. bond paying 5%. You're paying 0 on the loan and earning 5 on the investment. You just pocket the difference.
Borrow at 0, invest at 5. It's free money.
It was a money printing machine. Hedge funds did it, banks did it, everyone did it. But now look at the equation. The yen is strengthening up 1.7% recently, and Japanese rates are rising.
So the cost of the loan is going up.
Not just the interest. Think about it. If you borrowed yen when it was weak, and now the yen gets stronger, you need more dollars to buy back the yen to pay off that loan. The principal of your debt is effectively growing.
The trade doesn't work anymore. In fact, it's going backwards.
Not only does it not work, it's blowing up. People are rushing for the exits. They have to sell those U.S. assets, sell the tech stocks, sell the bonds to get cash to buy back yen and close the loan.
And this unwinding causes ripples everywhere.
It sucks liquidity out of the system. It exacerbates dollar weakness against other currencies because everyone is selling dollars to buy yen.
It's like a crowded theater and someone just yelled fire, but the exit door is getting smaller. It's a global margin call.
That is a very, very apt analogy.
Okay, so we have chaos in bonds, chaos in currencies, a liquidity crisis. Let's bring it all back to the headline. Why is gold the winner? Why isn't everyone just buying, I don't know, Apple stock or Bitcoin?
That brings us back to the $5,500 number. The reason is one concept: counterparty risk.
Counterparty risk. Okay, explain that like I'm 5.
Think about a bond. A bond is a promise. It's a promise from a government that they will pay you back with interest. Its value depends entirely on their ability to pay, on their solvency.
Right.
Think about fiat currency, like the dollar or the yen. It depends on policy decisions and the stability of the central bank. But gold has no counterparty.
It's just gold. It's a rock.
It's an atom. It doesn't rely on a government's promise. It doesn't rely on a prime minister's budget or a central bank chairman's decision. It's independent of creditworthiness.
So it's the only financial asset that is not simultaneously someone else's liability.
You've got it. So when investors look at Japan and say, I don't trust the government to pay the debt, and I don't trust the central bank to manage the currency, they go to the one asset that doesn't require trust.
And it's not just panic retail traders buying a few coins.
No. The data shows this is sustained demand across buyer categories. We're talking central banks, major institutions, high net worth individuals.
That's a key distinction. This isn't just fear, it's institutional positioning.
And every time the price pulls back, buyers step in immediately. It's acting as a specific hedge against sovereign debt pressures. Basically, if you think governments are losing control of their bond markets, you buy gold.
And Japan is the poster child for losing control right now.
Japan is the current crisis, yes. But here is the bigger warning. Japan is the canary in the coal mine.
What do you mean by that?
Well, Japan isn't the only country with high debt. They're just further along the path. Japan is a preview for other high-debt nations.
I assume you're looking at the United States.
The U.S. has a $36 trillion debt load. Europe is struggling with debt as well. If the bond market can break in Japan, which is a highly advanced, stable economy, investors start asking, why can't it happen in the U.S.? Why can't it happen in Europe?
That is a terrifying thought, the idea that U.S. Treasuries could face a similar buyer strike.
It signals a massive shift in the era of central banking. For the last 20 years, we've been in the era of growth optimization. Central banks trying to tweak things to make the economy grow a little faster.
And now?
Now we are entering the era of crisis containment. Unconventional tools like quantitative easing are being tested to their absolute limits. We are seeing that you cannot print money forever without consequence. The bill is coming due.
So for the listener trying to navigate this, what should they be watching? Obviously the price of gold, but what are the leading indicators?
You need to watch 3 specific things in the coming weeks. First, the next Bank of Japan policy meeting. Any shift there changes the game.
Raise rates or print more?
If they raise rates, the banking crisis risk goes up. If they print money, the currency crisis risk goes up.
Okay, watch the BOJ. What else?
Second, upcoming U.S. employment data.
Why employment data?
Because that dictates what the U.S. Federal Reserve does. If the U.S. economy weakens, the Fed might want to cut rates. But if bond yields are spiking because of Japan selling treasuries, the Fed might lose control of the long end of the curve. It puts the Fed in a nasty bind, too.
And the third thing?
Updates on yen intervention. If Japan officially steps in to buy yen, that implies they are selling treasuries to get the cash. If you see that headline, expect volatility to spike across all asset classes immediately.
So buckle up. This isn't over.
Not by a long shot. Expect prolonged volatility. This is a structural unwind of a 30-year economic experiment.
So let's summarize. Japan's massive debt and new stimulus are pushing yields up to levels their system wasn't built for. The Bank of Japan is trapped between saving their currency or saving their banking system.
Right.
This pressure is spilling over into the U.S. via treasury sales and the unwinding of the carry trade, threatening our own rates. And gold is skyrocketing because it's the only asset that doesn't rely on a government promise that looks increasingly shaky.
That is the perfect summary.
You know, it really makes you think. We've lived through decades of easy money. We got used to the idea that debt doesn't matter, that we can just kick the can down the road forever. But Japan is showing us what happens when the road runs out.
It is a harsh reality check.
I want to leave the listener with a thought today. We look at Japan and think, that's over there. But if the world's third largest economy can't handle a 2.25% interest rate without shaking the global financial system to its core, what does that say about the stability of your own local currency? About the money in your savings account?
It's the question everyone should be asking right now.
Keep your eyes on the charts, everyone. It's going to be an interesting week. Thanks for listening to The Deep Dive.